On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Yes, Luke Smith from Envision Financial Services right here in my studio in living colour. Good afternoon.
Good afternoon. Living colour.
In living colour, that's right. Do you remember when they introduced colour TV? They were saying all sorts of things like that.
I'm not that old.
Of course you're not. I am.
You are. You got me there.
Look, let's start on a positive note today, and we'll cover the share market and everything a little bit later in the program, but it has closed in the green today, I think for the first time this week, up by more than 0.5%.
Great.
So that's a positive result. But in that context, today's topic is how can I make the most of the Trump effect and the recent pullback in markets. Now, I've heard plenty of people say, well, you know, when the markets are taking a tumble, that's a buying opportunity, isn't it? Well, I don't know, is it?
Well, and again, that's a great segue because we've had a very, very strong period over the last few years. We saw one stretch of time when we saw interest rates rise and markets come back a little bit. And I think people can sort of start there and reflect on what happened. Interest rates rose very quickly. Fixed interest and Australian equities fell very sharply over a 12-month period. But then what did we see off the back of it? We saw a very strong recovery, and we've seen some very, very nice returns over an extended period of time, to the point where we've been talking on this show for quite a while, and most commentary has agreed for many, many months that a lot of valuations have got very, very high and very, very stretched. You know, CBA is a great example. Most expensive bank in the world, and the income that it generates is actually less than you'd get putting it in the bank.
Right. Well, that's alarming, isn't it?
Well, it's the first time in a while that the yield from something like CBA is less than bank interest, because bank stocks notoriously were held by people in massive over allocations or overweight positions for the income. And you generally held the big four and maybe throw in a Telstra back in the day, and they were held for income. Well, if you buy it now, you know, at the high of, you know, we got to 160 something CBA, you were getting a very, very poor income stream. So that's a great way to start thinking about what am I holding and what are things doing in my portfolio. If most growth portfolios, which is sort of balanced from an index fund perspective or from an industry fund perspective, did December to December 18 to say 22%, right? That is wildly abnormal. A 70% growth, 30% defensive portfolio, which again is a rough label of balanced in an industry fund, if that did 6 to 8% on average, that is a fair and reasonable expectation of a normal market return. You'd get 3 or 4% in dividends, and you'd get 3 to 5% in capital growth to get you to that sort of 6 to 8% depending on what you hold. So if we look back and say 12-month numbers to December were doing 18, 19, 20%, that's bonkers. So to see something pull back 5, 6, 7, 8, 9, 10%, it's not the end of the world, because markets don't like inconsistency. They don't like shock. They don't like surprises. They like to see information and data that is in line with expectation, whether it's right or wrong. And we've just come through a reporting period where a lot of the reporting information in most sectors is quite strong and within expectations. The market has been quite ruthless on companies that have not met expectations, and we've seen that with some very, very good quality stocks coming back to what would now be a far more appropriate entry level, because we need to think about spending cash and saying, am I buying something for income or am I buying something for growth? And at the moment, a lot of people are concerned. Totally understand that. But in the context of a bigger picture, I don't believe this is anything to worry about in relation to your broader superannuation, your ability to retire, your ability to fund yourself. Because people need to separate that the share price is a reflection of sentiment. Do we like the bank? Do we not like the bank? And in a banking example, the Banking Royal Commission was a great example. So a few years back, everybody said, oh, the bank are monsters, and everybody got upset, and there was an inquiry into it, which really led to nothing positive for the consumer. But everybody got to have a chance to have a bit of a moan and poke the bank. And during that event, Commonwealth Bank went from about $83 at a high to about 60 because everybody was, ooh, the banks. During that time, they also came out and said, we just made $4.5 billion profit. My point of that story is the income stream out of CBA was still very, very strong, even though the share price had moved over $20 a share. So people need to separate. If the share price has fallen, the earnings will fall. Not necessarily. It comes back to the quality of what you hold. And this, for me, is an opportunity where I've been saying for the last 12 months, things are expensive. Let's just cool our jets. I actually like the fact that this has pulled back because it gives us an opportunity to buy good quality stock in various sectors that was potentially overpriced to the valuation that was recorded, what researchers say, and for you to buy an income from a particular investment. Because there's no point buying something for income if you're getting a 2 or 3% yield when you can get that in the bank with no market risk.
Yeah.
So this pullback, CBA is a great example. I think it's still expensive at 140 something. It was ridiculously expensive at 160 something. At 140 something, I'm still not a buyer. Now, I might be right, I might be wrong. Let's see. But again, you've got to come back and say, why am I buying something and what is it doing for me? CBA could give you a really good income stream. So could NAB, so could Wesfarmers, so could a range of stocks. You go and buy CSL at the moment that's trading at $250. It's not an income stock, it's a growth stock. Woolworths, another good example, $28.50. You go back 12, 18 months, $34 to $38. At $28, you're probably on a 6% fully franked income. Now, if they have a 91% payout ratio, is that sustainable? Probably not. So I'd be factoring that into how much you hold of that investment because people have still got to eat. Coles is another good example. So there are loads of examples in the market where you can look at something and say, why am I buying it? And what is it doing for me? And I think people have some frustration because they hold stocks thinking everything pays a massive income. It doesn't. Cochlear, another good example. Come back to a more appropriate level from highs of over $300 a share. I think it might be at, don't quote me, $260 today. But are people going to stop using hearing aids? I don't think so. ResMed, sleep apnea. Are people going to stop using machines and die? I don't think so. So again, if you buy good quality stock, I don't think you need to panic about the viability of what you hold. Yeah. If you hold a diamond mine in Uganda in the current environment, yeah, I might be a little bit more concerned about what's going on. No dramas. But if you hold good quality stock and you get a good income stream from your portfolio and you have a suitable level of diversification, I think people need to not get wrapped up in the noise and the pressure and the assumption and misconception of what's going on. Yes, things are volatile. I understand that. I appreciate people are concerned. I get that too. But in the grand scheme of I've got 35 years till I die and I'm going to be retired for the next 25 and I have 1 to 2 years pension money in the bank so I don't ever need to sell something, with that context, are we still panicking about the day-to-day movement of what Trump might or might not say, a tariff he may or may not put on? And for, from his perspective, either put them on or don't put them on. Don't dangle them out there like a carrot and then change your mind.
Yeah.
That's what scares markets and causes volatility.
And that's why we've seen the gyrations over the last couple of weeks.
Totally.
Just a quick update for you on some of the shares you've mentioned. CBA closed today at 142.36. Cochlear closed at 262.28. CSL closed at 250.05. So there you go.
So I'm pretty close.
Very close.
Cochlear, mate, February, that was a $300 stock. So we're talking about some significant movements. I think Wesfarmers is another one. It hit a high of about 77. It's at 70, 71 at the moment. And again, when we think about Trump and the effect of Trump, is Bunnings going out of business? I don't think so.
No, they're not.
And this is where people need to separate the noise of Trump and the impact of tariffs. Yes, tariffs will have an impact on different parts of the globe and the cost of delivery, and you can get right down a rabbit hole with that if you want. But if we bring it back to a simple approach and say, is that going under? Is CBA going under? Is Macquarie going under? I don't think so.
No.
You know what I mean? So if you buy good quality stock, now's a great time to say, hey, could I buy a few more? Another idea at the moment is to say, well, if I did happen to buy CBA at 165 and it's 140 something at the moment, do I sell it and buy it back to reset your cost base and lock in that loss for future benefit? Because you can carry forward a loss forever. And if you buy it back, you're not out of the position. But you might sell it in a super fund, buy it in a trust. You might sell it in a super fund, wait an appropriate amount of time and buy it back later if you think it might go lower. So don't look at everything as it's bad. Look at it as a strategic opportunity to be a little bit more dynamic about how you construct your portfolio, and look for some opportunities where good quality companies are now coming back into range, and maybe deploy some of the cash that you have in the fixed interest part of your portfolio or in your cash account, and buy things and nibble away at stuff. If you want to buy something at the moment, maybe don't go out and throw the kitchen sink at it. If you're going to buy $50,000 of something, buy 20, and then keep an eye on the market. If it falls a little bit more, buy a little bit more. Nobody ever got upset about buying something at a discount. People get very upset about not being able to buy any more because they thought the last buy was the best one. So keep that in mind when you're staggering in. Check your asset allocation and make sure you understand the risk profile you are truly carrying. And this is where a lot of industry funds are going to upset people, because people hear the word balanced and they think 50-50. They think a flat seesaw. They think half and half, because half and half is what balanced really means, right?
Well, you would think so, wouldn't you?
You would think so, yeah. Right? So now people come into my office and say, oh, but I've lost this much. They don't realise they're running 35% international. They don't realise they've got an exposure to the tech sector. They don't realise they're holding 25 to 30% Aussie. They think they're holding much smaller allocations because they're balanced, whatever that means. But if you come back to what is my asset allocation, your asset allocation or your risk profile will have a direct impact on how you're exposed to a change in the market and how you can recover from a market. And I would caution people from being fully out in the current environment, because we've seen on a number of occasions that you can have a market come off 5%, 6%, 10%, and through a change in sentiment or information, you can see it rally 5 to 10% as well. And we've seen a few of those over the last couple of years. So I would caution people from leaping out totally, because if it jumps, you're going to miss out on a lot of the upside very quickly. And I understand that it takes some nerve to ride things out, but you've got to come back and be rational about it and say, do I hold really high risky stuff? Yes or no? Do I have a suitable allocation to different sectors, i.e. well diversified? Do I have a small holding in individual stuff? And this is where holding 40% of your portfolio in CBA is really going to hurt you, because you can have too much of a great company. So think about your individual allocations. Be dynamic. Think about selling and buying back and using a loss position to build up some gains for later that you can use, because, as I said earlier, you can carry forward a loss forever, but you can buy something back and hold it, or give yourself some time to let the dust settle and then buy it back, or sell half. I'm not against selling half of something so that you take a little bit of heat out. But if it rallies again, you're not completely unexposed, which can be then very expensive if something moves against you. So keep those things in mind and try and stay rational with your thought process, and don't let the ladies at Mahjong roll you up and say the world's going to end, because we always come out the other side of a storm.
In the immortal words of Douglas Adams, don't panic. Now, Luke Smith from Envision Financial is with me in the studio today, and we're talking about how can I make the most of the Trump effect and the recent pullback in markets. We'll be back with more in just a moment. Seven minutes to 5 on a Friday afternoon, which means Luke Smith from Envision Financial is with me in the studio today. We're asking the question, how can I make the most of the Trump effect and the recent pullback in markets? And to put that in context, we've actually seen the market go up today. So there's a lesson in that, isn't there?
Look, I think people need to be patient. and I say to most people that come into my office with some concern, are you going to spend all your money in the next 2 to 3 years? And they say, well, no, it's going to last me for the next 35. I said, okay. And we've got 12 to 18 months of money in cash. So we don't need to sell anything for the next 18 months to live the way you want to live. Are you still concerned? No, not really. The same mentality was said through COVID. Oh, COVID's happened. The values have come off. I can't retire. Oh my God, oh my God. And in a not too distant future, we were back at higher levels, like we've seen up to February, that surpassed the value pre-COVID and post-COVID.
That's right.
And I think that's the context people need to keep things in mind. This is a marathon, not a sprint. Hold good quality investments. If you have cash and want to start to nibble in now and buy some good quality assets at a significant discount, look, a 10% pullback, if that happened once every year, it's not terrible. It's just normal. You start talking 20 and some of the movements like COVID, they were severe. But we also hit a point where things are such great value that people start buying, like we saw in COVID. It fell very, very quickly and it recovered quite quickly because the news changed. We reacted to a virus. We didn't know what was going on. Things fell. Oh, hang on, we can, and we're gonna, and we've come out, and here we are. And I think...
And look how cheap all these shares are.
Correct.
I'm going to buy some.
Well, let's look at COVID. Macquarie Bank was what? 200? 180?
Something like
Before
that.
COVID? Hit $79.
Yep.
Right? February, it was 244.
Yep.
With 3 years in the making. Bank didn't go under. Perception of value changed, but it came back to its core business. The world carried on, and we forgot about it, like goldfish. And I think people just don't be a goldfish. Think longer term, think asset allocation, add into portfolios, transfer money into super if you have cash. People say, well, is now a good time to add to super? I would argue, yeah, potentially it is. Could things go lower? Yes. So if you want a dollar cost average and mitigate risk, buy little bits regularly over time, and you could keep buying for the next 12 to 18 months. And if things fall, you're buying more good quality stock at a cheaper price. Don't buy things that are highly speculative. And if you do understand that, you know what you're up for, and that's fine. Look at your asset allocation and think about how you're feeling. If you're in a balanced option somewhere that is not actually balanced, there is concern over seeing a value fall, because in an industry fund, you don't know what you hold. You don't know your weightings to stuff. You don't know the individual holdings. So if you think you're balanced, now might be quite a good time to sort of look and see how you feel and go, can I tolerate this? Is it really for me? And if the answer is, well, no, I've got some concern, then look at a more defensive asset allocation. But don't work off a label. Work off the exposure to growth assets at 50, 60, 70%. If you can buy with cash, great. If you want to transfer assets in specie, when you're talking about a change of ownership, it could be a good time now to transfer assets into super to reduce a potential capital gain, because you're transferring CBA in at 140 something, not 160 something. So don't just look at what's happening at the moment as something that's bad. Look at it as an opportunity to try and reset your portfolio, lock in losses for the future, add money and dollar cost average, and buy good quality assets at discounted prices. And remember that you're going to be invested for a very, very long time. And I don't believe your risk profile needs to change from your working time to your retirement time. And keep things in perspective.
So where can listeners get more information?
Yeah, office number 6260-4749. We've got Envision Financial, that's Envision with an E, .com.au on the internet, where we've got all the podcasts. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where you can subscribe and get a back catalogue of all of the shows and all of the data that we've shared in the past. And all of this type of asset allocation information and risk profiles is in Smart Money Strategy, your ultimate guide to financial planning, and all good bookstores and Kindle.
Fantastic. Luke, have a wonderful week, and we'll catch up with you again next Friday.
See you next Friday.
Indeed. Luke Smith from Envision Financial.